Thanks for having me on. I'm the CEO and founder of Infrastructure Capital. I've been on Wall Street for 37 short years after I graduated from Wharton and with a degree in finance. About half that time being an investment banker, mostly at Morgan Stanley, working at large hedge funds. And then 17 years ago, I founded Infrastructure Capital. We have 7 ETFs, 6 are in the US, 1 in Europe. All of them are focused on monthly income and are infrastructure type investments. 2/3 of our assets are in fixed income, and we do think that that's a critical distinction to investors. So a lot of investors will say, oh, well, I can get great income by this MicroStrategy call rating, and they get 82% income, but their total return is -18. We're focused on primarily fixed income, and we like higher risk fixed income, so lower risk than equities, but higher risk. So we have a bond fund and a preferred stock fund, and most of the bonds and preferred stocks we hold are in old economy type companies. So they're more stable, they're asset intensive, they have lower default rates. So that's our core philosophy: generate substantial lower risk income from infrastructure style investments, and even better, senior to common, either bonds or preferreds. Well, we think so. We spend a lot of time on macro analysis, and I'd recommend, even if you aren't interested in our ETFs, looking at our data on our website. It's very unusual, proprietary, and we've had great track record of making forecasts. So we're forecasting a strong stock market in the US, which probably means the rest of the world as well, at some level at least, maybe better than US, and also declining interest rates for one and only one reason, which is that inflation is very, very likely to decline. We have that forecast on our website. So that's a great market to invest in fixed income generally, but if the stock market's strong, you should get a tightening spread. So the higher risk portion of fixed income, like high yield bonds and preferreds, normally do outperform when the Fed or the central bank's cutting rates and long-term rates are going down slightly and the stock market's strong. So preferred shares are fixed income in our the way we look at it, and specifically because they're senior to common and they don't participate in the upside of the common, and they get paid first. And we do think it's in addition to the macro environment, a great asset class because we exclusively focus on preferreds that are issued by public companies. And there's been a lot of concern about private credit in the US. And we think some of those concerns, we think it's overblown a little bit, but some of those concerns are relevant. Private companies are fundamentally riskier than public companies. They can't issue equity. They don't have to report to the SEC. So we think preferreds are a very attractive asset class. The preferreds we buy are also listed, but more importantly, the issuers are listed. There's substantial market caps. They care about their credit. They will do whatever it takes to maintain their credit, issue equity, sell assets, stop paying common dividends, but not preferred. So I'd recommend the asset class to anyone, and you can buy them individually. You can use our ETF, you can use other ETFs, but a great asset class for almost any investor because you get almost equity-like returns with lower volatility. So the coupons are in the 7, 8, 9 range. That's almost equivalent to an equity type return, but you get more safety because you're senior to common. Well, what we'd love is to, in effect, arbitrage the rating agencies in the US. So they're pretty old school. So they don't like preferreds. They notched them 3 times. So a full rating category. So if it was BBB, it would be BB. And we think that doesn't make any sense for strong credit. So we look for investment grade bond issuers, but non-investment grade preferred stock issuers who get really low default rates, but quite good yields. And so it's a way for us to take advantage of the fact that the rating agencies are inefficient in our view.